Good afternoon, financial professionals. My name is Jennifer Nadeau, case designer here with E4 Insurance Services, and welcome to The Brew, building relationships every week. For those of you tuning in for the first time, welcome. We like to start off the Brewcast by celebrating today's National Day. And as usual, we have quite the diverse list to go over with you today. Today is National French Fry Day. It's also National Beans and Franks Day. It is National Delaware Day. And last but not least, it is National Barbershop Music Appreciation Day. And I'm not saying that social media is the best place to confirm info, but I will say I saw a post that a certain chain restaurant might be giving out free fries today in honor of National French Fry Day. With that being said, we would like to welcome Jason Jafferis, Vice President at Prudential. Today, Jason will be talking about a strategy that we can use when doing policy reviews and uncovering contracts that have overloan policies where premiums can't be paid and the loan cannot be addressed. We'll talk about a specific case study and also talk about how to implement this type of strategy. So Jason, welcome. We are very happy to have you on The Brew today.
Thank you very much, Jennifer. Appreciate it.
Yes, and I know that you and I had a discussion prior to having this call today, and you will be discussing mirror loans as part of the policy review analysis and potential issues that may come up, and utilizing the mirror loans as a strategy as well. So I was hoping that you could just take a moment and talk to us about what exactly a mirrored loan is.
Certainly. Thank you. And thank you everybody for being on the call today. The concept of mirrored loans, and you may have heard it called loan rescue, is nothing new to the industry. However, there's been some significant changes that have allowed us to provide a wider range of solutions for clients that find themselves in this predicament. Mirrored loans traditionally come from an older life insurance policy. They're uncovered through a policy review. The loans may or may not have been taken out as a distribution from the client. If they borrowed money from their policy, they obviously know that they have a loan on the policy. But oftentimes with older whole life contracts, if the client has missed premiums or the dividend rate that was assumed has decreased, whole life policies are very restrictive in that annual premiums are due every year. And if that annual premium is not met, either through the remittance of premium or using dividend to pay the premiums, a loan is automatically applied to the policy. So they call it APL, automatic premium loan. And those are usually kind of phantom loans that clients are really unaware that they have. And they can build into significant issues for the policy over time. Many of the older policies have very large interest rates. If you think of the mortgage industry, and we're seeing this right now, right? If you would have refied or bought a home 6 months ago, you probably would have been somewhere in the 2 to 3% range. But if you go to buy a house right now or refi, you're probably more in that maybe 4.5 to 6% interest rate. At which point in time would you like to buy, right? You definitely want the lower interest rate. And so with the older policies, when you're seeing a 6 to 8% interest rate that's being applied annually to that loan balance, if they're not paying the interest, it just gets added into the loan balance year over year, and that loan and that interest rate continue to build over time. So what we've seen is that specifically with older policies, there usually was kind of a 10 pay or 20 pay type of structure when dividends were very high. Client hasn't paid premium in 20 years, and all of a sudden they're getting a bill that says you owe $30,000 or $40,000 in order to keep this policy going. And really what we're trying to do with this loan rescue or mirrored loan strategy is help clients avoid the out-of-pocket cost for that. We're trying to find solutions that will minimize the out-of-pocket, but also protect them from the tax hit that could potentially be there. So what you see on your screen here are the 3 options that we walk every client through. Whenever they uncover a loan, we have 3 options. You can do nothing and just let the policy ride. and an in-force illustration will tell you how that policy is projected to perform over time. They can make changes to the policy, potentially paying the premium, paying the loan back, paying the interest annually, and oftentimes we'll help them calculate what that out-of-pocket looks like year over year. With a 6 to 8% interest rate, those numbers can become very large. And then the third option is, if we rolled this over into a new policy, what would it look like? How could we take advantage of lower interest rates on loans inside newer products, and also better cost structures and flexible premiums on universal life products versus whole life products that would allow them to be in a better position to maintain that policy with less out of pocket. The thing we're really trying to avoid is, if that policy lapses, that is an ordinary income tax hit to the client. And oftentimes when we talk about really loaned out policies, and we're talking 85 to 90% loan to value, that can be a six-figure hit in terms of an IRS check that needs to be written in that year. So we're really trying to help clients avoid that massive out-of-pocket expense and trying to kind of minimize that over time.
Great, thank you for that explanation. When you and I were speaking before, you had mentioned that 7702 can really help identify some of these opportunities, if you will, as well. Would you mind, Jason, just giving us a brief reminder of what 7702 is, and why you had mentioned that this is giving us even more of an opportunity now?
Definitely. So 7702 was part of the Consolidated Appropriations Act of 2021. Ultimately, it was a spending bill that included stimulus relief in response to COVID-19, but it also changed the interest rate assumptions for IRC code 7702. That interest rate assumption was last updated in 1984. And interest rates, if those of us who were alive in 1984, interest rates were very high in 1984 compared to today's interest rates. And so this change to the 7702 assumption allows more cash value and more premium to be put into policies without pushing up the death benefit. So the problem that we had with highly leveraged loans in the past is the size of the cash value and the size of the loan pushed the death benefit so high that the policy, we didn't have an opportunity to help the client. There was just too much spread between the death benefit and the cash value to really create a meaningful solution. It required just too much out of pocket from the client's end to consider this. So prior to this change, we had about an 80% loan to value maximum that we could look at. Anything higher than that, it really forced us out of the market in terms of just being a solution. Now with the 7702 interest rate change, we can look at policies up to 93, 94% loan to value and find a solution. It allows us to kind of minimize that death benefit and add that cash value and loan into the policy without creating any additional costs and charges with pushing that death benefit higher. And just for everyone on this call, when you have a policy that's loaned out 90%, 92%, the death benefit really isn't a concern at that point. It's really making sure that the tax hit doesn't come this year. So what we're trying to do with that, we're minimizing the death benefit to make sure that we can keep it in force to get you some coverage, right? You've already loaned out all the cash. You've already used the value of the policy. Now we're just trying to make sure you don't get taxed on that value.
Perfect. Yeah. And really important, as the intent of these policies was to not incur.
Correct.
Yeah.
Yeah.
Is there anything else that we need to be aware of when implementing this strategy, or even helping to identify these clients?
Yeah. Oftentimes when we uncover these, there's a hesitancy to look at it because of producers or advisors are unsure how everything works. What is taxable, what is not? Can we just take a withdrawal from the policy and pay the loan? Can we just 1035 the policy over to a new carrier and extinguish the loan? So the thing to be really cognizant of is what is the cost basis of the policy? Mm-hmm. If I've got a policy that has a $50,000 cost basis, $200,000 of cash and $150,000 of loan, we know that there's gain in that contract, right? So there is gain there. If they do a 1035 and extinguish the loan and don't mirror the loan with the new carrier, you're creating a boot tax situation, meaning you're gaining an additional benefit from a 1035. Now, a 1035 for the IRS is a like-to-like transaction. So if one policy has a loan and the next policy doesn't, that is not a like-to-like transaction. So you have created an additional value through that 1035 by not mirroring the loan, and that will trigger boot tax, which basically is an ordinary income tax on the gain that came over from that contract. So being cognizant of what the cost basis is, what the net cash value is, what the gross cash value is, and what that loan amount is, can help you determine, is this something that needs to be fixed? If it's a policy that has 200,000 of cost basis, 100,000 of cash and 50,000 of loan, you don't have gain in the contract. There really isn't a loan rescue or mirrored loan situation that you need to attend to, but there are certain strategies that you can look at in terms of what should we do with it. But the tax concern isn't there. Whenever there is gain in the contract, that's where these types of solutions need to be looked at to determine what is the best course of action. Oftentimes when we show them the do nothing option, sometimes that's good enough. Sometimes they're okay with, hey, the dividend is paying my interest, I'm okay with it, let's just move forward. Most of the time, I would say 90% of the time when we see these, we're able to offer a solution to the client better than the policy that they have in hand, simply by refinancing the interest rate. We're taking them from an interest rate down to a 1% interest rate, and who doesn't want that?
Absolutely. And also some of these policies are quite a bit older as well. And as we know in the industry, products and solutions have progressed, right? So another reason why there may be a better solution. And something that you mentioned, Jason, as well, as far as people being hesitant to look at the contracts because they're just not sure what they're looking at. I know that you are very, very knowledgeable. You have a great team behind you. I'd also like to mention to everyone that here at E4, we also can, along with Jason's team, but we can also help you determine and look at in-force ledgers and statements and help determine what you've got, what you're looking at, and what the best possible solution would be for your client, because those in-force ledgers can be very daunting, especially when there's a loan on them.
Yep, I would agree. The other point I would like to make is smaller policies tend not to be as viable in this program. So our rule of thumb is we don't really look at a loan to value as a be all end all. All we typically ask is that there's at least $25,000 of net cash value in the policy. We have to be able to pass compliance, meaning when the 1035 comes over, we have to be able to make sure that on its own, without any repayment, without any premium commitment from the client, we can make it through the first year. That's our compliance checkpoint. It's a good thing for you. It's a good thing for the client to make sure that we're at least going to make it a year. But then we'll also build out the concept to show you that we can make this solution last much longer. We have products that have guarantees in them. We have products that have accumulation factors in them. We can use any product really that's in our portfolio, which is another nice feature. Other carriers might only have one or two products that are specifically designed for this type of program. Mm-hmm. We have our entire array of product is available. So even if there's a survivorship policy that is out there that has a loan on it, we have 3 different survivorship policies that we can use for this type of concept.
That's wonderful. And also, as a reminder, it just needs to be like to like, right? So same
Correct.
Owner, same insured. We could go from whole life to IUL or a GUL, or not that GUL is the best for these types of solutions, but as long as it's the same owner.
Correct. Yep.
Yeah. Great. Yep. Wonderful. Well, that was great information. I would like to remind everyone that there is a chat box feature that you can use to ask questions, or you can certainly unmute yourself and ask a question as well. Are you okay, Jason, if we open it up for questions now?
Yeah, that'd be great.
Okay, Great. While we're waiting to see if there are any questions, I would like to remind everyone that you can see the full library of the brewcasts on our website, and that is at e4.insurance. And also, if you wouldn't mind, Jason, let us do our drawing as well. If you could please pick a number between 1 and 35.
Between 1 and 35, I'm going to go with 22.
22. And that winner, congratulations, it's Daniel Flees. Congratulations, Daniel. Please be on the lookout for a complimentary CE voucher and also a gift card from Starbucks that will be coming your way from everyone here at E4 Insurance Services. Congratulations. I am just looking at the chat box for questions. You're very welcome, Daniel. And you can also unmute yourself if there are any questions out there. I'll just give it another moment or two. And I'm not seeing any. Jason, any closing comments, or did we pretty much hit it all in our session here?
Yeah, I think we hit it all. The one thing I would just like to remind everybody, when you see a loan on a policy, it's the sign of an opportunity. Call E4, call your wholesaler, gather as much of the details as you can. There is typically a solution here that's better than what the client has. Another thing that we're seeing lately, just on our own in-force block of Pru business, just to kind of give you an idea here, is with the economic downturns that we've seen, one of the buckets that clients dip into to make up for some extra income is their life insurance policy. So we have seen loans being taken out on our existing in-force book of business. Now, doesn't mean we need to rush to fix them. It just means if you have clients that are currently accessing that, those are policies that definitely need to be reviewed annually, taking a look at how that interest and loan is affecting the policy. At some point in the future, could be the near future, could be 15 years, 10 years. There's a possibility that a strategy needs to be implemented to make sure that that policy remains in force and obviously improve the health of it.
Great. Excellent closing comment and point. Please join us next week for the brew, where we will have Jeff Murtha joining us from Mass Mutual, and he will be reviewing the myths and misconceptions of whole life insurance. So please be sure to tune in with us next week. And I thank you, Jason, again, for joining us today and the great information that you shared.
Thank you, Jennifer. I appreciate it. Thank you, everybody, for taking time out of your day.
Yes, thanks, everyone. And please tune in next week and have a wonderful rest of the week. Thank you.